Well, hey, for those just checking in, this is Joshua Meeks with the PNW team at Keller Williams Realty and Andre Bohall at the PNW team at Keller Williams Realty and Stephen Wright at Movement Mortgage. So we are just coming to you live today with yeah, that's right, and ASL interpretation. I'll hashtag that afterwards. So we're coming to you live with a April monthly market update. A lot of times you'll see these updates in our newsletter if you're subscribed, or on Facebook or YouTube, or on our Instagram, IGTV channel. So this is just an opportunity to share with you all what's happening in the real estate market. Love having Stephen Wright's insight as the best lender in the Pacific Northwest, and just hearing what's happening, from his insight on the mortgage aspect. So wanted to jump in real quick, run through some quick numbers that we always look at here in the Pacific Northwest. Real quick, want to let you guys know over this last month, homes available have increased from 6,675 to 8,172. In spite of some increased buyer caution in this market, we saw the amount of homes under contract increase from 5,838 to 6,685. And the amount of homes sold increased subsequently as well from 4,639 to 5,851. What do all those numbers mean? It means over the last 30 days, the amount of homes available went up, the amount of homes under contract went up, and the amount of homes that have recently closed increased as well, meaning even in the midst of what we would perceive as a shift in the real estate market, we're still seeing that buyer demand. Average price per square foot all across the MLS. Keep in mind, this isn't just Pierce County, this isn't just King County, this is really the majority of Western Washington. We saw the closed price per square foot increased from around $270 to $280 per square foot. We saw days on market actually drop from 48 days to 37 days on market over the last month. However, keep in mind, all these stats are from last month. So we will, I think, see, probably a little bit increased days on market. And the months of inventory, meaning how many homes are available if no more homes come on the market, plateaued from 1.4 to 1.4. So one of the things that we're stating in this is where it ties into Stephen as well a little bit here is that we've, a lot of our industry is dependent on what's happening in the mortgage industry. A lot of times we'll say, terms like your real estate agent's your quarterback, your lender's your running back, or, these analogies that let you know that we have to work together, your lender, your real estate agent, you as the buyer or seller, throughout this whole process. So, we're starting to see a few more homes come back in the market, a little bit more than we have, and we're starting to see some lending regulations change. So, Stephen, what's happening on your end with the lending industry?
So first of all, thanks for having me on the show. Always good to be with you guys. Either if I'm not on the show, I'm watching anyway. So I guess it kind of makes sense.
That's right.
So with the mortgage industry right now, obviously there is a lot of risk out there, or potential risk, right? And so every lender is looking at it differently, trying to figure out, hey, how do we make it through with the least amount of risk to our company as possible? And that happens in some cases. We've seen, people change minimum credit scores from 520, 580. Now we're up to 620, 640, 660 in some cases. We've seen restrictions on debt to income, kind of tightening the box, at least for the short term, in terms of people that can qualify right now. Again, because of the talk of forbearance, because of people, 10 million people have filed for unemployment. There's just a lot of risk out there for lenders. So we're hoping that, we get past this COVID crisis quick. We want to get past the pandemic. We want people not to be sick anymore. And we want to get back to work, obviously. So the quicker we can, see some light at the end of the tunnel, the quicker, obviously, restrictions like that get removed as quick as possible. Because we want as many potential amazing homeowners as possible to get in to home. So that's obviously our goal. So in the short term, like I said, very lender specific in terms of what lenders do, because they have the ability to do that. But we've seen a lot of restrictions, a lot of shutdown of kind of one-off programs, we'll call them, like bank statements instead of actually approving income. We've seen, other things like that kind of go away. Jumbo, obviously, if you're going to write a loan for $1 million, 2 million, stuff like that. There's a lot more risk in that. We've seen those kind of potentially go to the sidelines for now. But again, like I said, I think the good news is that this should be a short term and we should be back to normal at some point. But the good news is interest rates for those that still qualify, fantastic. You know, we're seeing 3s and 4s, obviously very dependent on the loan, on debt to income, on credit score, all that kind of fun stuff, but still historically very, very low interest rates, quick closings, all that kind of fun stuff. So, you know, we're trying to make it as business as usual as possible, just with a few changes here and there.
Yeah, for sure. I mean, and I think that's something that we see every business doing right now, is that as the market shifts a little bit, as, you know, a lot of businesses aren't even able to be, you know, in their office, we're here from home, we're having to mitigate risk, and everybody has a different way of mitigating risk. And those that aren't mitigating risk, you know, might regret it later. And those who are, I think, are putting themselves and their clients in the position of knowing that we're going to be around to serve them for the long term. And that's something that we definitely appreciate. And I see businesses across the board doing that. So, and it sounds like, you know, those who are highly qualified, especially, or, you know, are very, you know, in that comfortable, less risk sector of buying homes, it is business as usual for a lot of those people still, correct?
Absolutely. Yeah, I mean, like our couple programs we have for FHA and VA, we've gone to a minimum score of 640. So you can imagine that there's still quite a bit of people that still go above that 640 range. So yeah, there's still a great potential for a lot of people to still buy homes if they're in a place to be able to do so.
Yeah.
And like I said, the good news is this should be a short term. We'll get back to offering all kinds of programs for all kinds of different amazing borrowers. So.
And I think one of the things that we notice with ours as well is that, especially people in my demographic, maybe specifically, is that these are smart investors. They're smart home buyers, smart, you know, homeowners, and the majority of them aren't trying to max out their income to debt ratios. They're not trying to make unwise decisions, and those are generally going to be people that are comfortable, that they're making, you know, decisions that they're comfortable with, and that lenders are still likely comfortable with a lot of those decisions as well. If I know, and I know this is a lot deeper of a conversation, but would you be able to recap for me in a very, very simple aspect what Ryan Hills was able to share on REsource on some of his content from what's happening on the back end of the industry? And I know that's a deep, deep question, but on just in very layman's terms, if it's even possible to explain how that change of refinances and restructures in some ways is impacting the mortgage industry.
Yeah, I actually saw a good explanation of it just recently from Frank and Brian. So they're another amazing TV host. But yeah, who they're talking about is the REsource, which is hosted by Ryan Hills and RC. And they've done it for 10 years. So amazing content. So obviously they've had a few different shows on the topic, but basically the problem right now is a couple things. One is capacity. Obviously, when we hit the lowest interest rates that we've ever seen, again, we being the whole industry, got inundated with massive amounts of refinances.
Yeah.
So add that to a healthy buying market, and all of a sudden, lenders are completely taxed out. How do we ever staff for this? How do we fund it all? And then all of a sudden, COVID-19 comes, and it's forbearance. We hear all these other things of people that might not make payments. So a lot of lenders that are non-depository, so think of people that aren't Bank of America, Wells Fargo, places like that. They have basically, what I heard today was you have a credit card, right? And you have a credit card of $1,000 limit. You put $300 on it. As soon as you pay that off, you get your $1,000 back.
Yep.
So think about that now in bigger terms for non-depository lenders such as Movement. You have this giant line of credit. As you close homes and put it on that line of credit, obviously the key is to get them off of that so you can keep using that line. Well, now all of a sudden you have the potential where servicers don't want that loan anymore, or they don't have the ability to, or all of a sudden that person now has filed forbearance and can't make the payment. We run into issues obviously with not getting these people off the line. And then that obviously makes it so future business is impacted. And then obviously in servicers, we try to keep it really layman's terms. So basically the people you write the check to is your servicer. Those people in most cases have to still make that payment. So if PennyMac has my mortgage and I go into forbearance and I can't make my payment, PennyMac in some cases still has to make that each month. And that could be 6, 12 months down the line. Well, all of a sudden you do that for 100 clients or 1,000 clients or 10,000 clients. That obviously makes a huge financial burden for PennyMac. Now all of a sudden PennyMac can't take on new clients. Again, our line of credit's now full, and then it's just huge, this backlog of stuff. So the good news is we have some amazing people behind the scenes that are trying to get this figured out and try to get this, in through Congress and get everything they need to get that fixed in the back end. So we feel that, knock on wood, cross fingers, that will be remedied very, very soon. But that's kind of the issue we have right now. One, capacity. Two is obviously what we do with people that aren't making their payments. So,
that makes sense.
It's a tough time for a lot of people.
Yeah, and I think, even a lot of landlords, not a direct analogy, but are in a similar position that, if I own 10, 15 properties and, I still have to make my mortgage payments, but those people don't necessarily have to come up with the rent right away. Right. There's still some back-end decisions those landlords are having to make on that. So I want to show you guys one more illustration because we talk about months of inventory a lot, and it looks like Andre's frozen a little bit off and on. So I might have to catch up on, but a lot of times we talk about months of inventory, and I know just like some of the things that Steven was talking about, months of inventory isn't like a language that most people use on an everyday basis. And so I want to explain to you again real quick that the amount of homes on the market makes a big difference on the risk in the industry, right? So if we have 7, 8, 9 months of inventory on the market, like we did have, 12, 13 years ago, there's higher risk. There's a higher level of risk in that because people have to sell those homes. And the more that there's available in the market, when the market does adjust or shift, then it's like Andre might be popping up here on the lower side. So
oh.
7, 8, sideways. There we go. So the more homes there is on the market, the more of a dramatic you actually see. So I want to show this to you guys in a way that you might be able to understand real quick. Again, months of inventory, this is like a ton of months of inventory, and that's a higher risk market because there's a ton available. This is lower risk when it comes to inventory specifically. And if you're looking at it for risk, this is the amount of risk that, 12 years ago we were at. This is the amount of risk in the real estate industry for inventory that you look at. So think of it in the sense of like how big of a hole you can technically fall in and how bad that'll hurt. So right now, not bad at all. You might stub your toe, market shifts. You might see 1 to 2% of reevaluation of prices of homes. Stock market drops 30, 40, 50, 60% in some markets and some economies and some sectors. And the real estate industry, when there's not much available and there's still a massive demand, it puts us in a really strong position, not only right now, but that once we get out of this, we want to set up a really realistic expectation that once everybody goes back to work, there's still limited inventory. It's not like anything else that's piling up on the shelves that 4 to 6 weeks goes by. Inventory doesn't increase from 1 month to 10 months. It increases from 1 month to maybe 2 months. And that's still statistically a really strong, very strong seller's market. So if you look at what's happening in the real estate market with what's available, what's happening in the mortgage industry and the impact that has, I think at the end of this, most people, real estate agents and consumers, need to know that the people who aren't mitigating the risk in the real estate industry in 3 or 4 months might not be around. And it's an important conversation to have, not just for people in the real estate industry, but for consumers, people who are buying and selling homes like you all, because your real estate agent in 6 to 12 months, if they're not making lucrative decisions or haven't been in the last 2 or 3 years, they might not still be in real estate. Your mortgage broker might not still be in the mortgage industry, or the company itself, if they didn't have the assets to really mitigate or manage a pandemic like this, either business is going to look significantly different, or business won't be open at all, or people like Movement ideally will, within a few weeks, be right back as business as usual. and slowly start to open those things back up. So even if you had a conversation with a real estate agent 3 or 4 weeks ago, with a mortgage broker 3 or 4 weeks ago, and you think you have a pretty good of understanding, just know for us that our understanding is changing a day at a time. And so it's changing for you all too. Andre, appreciate you coming in clutch there with the reset video. Anything else you would add to that, Stephen?
Yes, I would say, if you have, impacts, obviously, first thing, if you can make the payment, make the payment. The world is a better place. If people that can make payments, make the payments. Beyond that, I would say, if you can't for some reason, talk to your servicer, figure out the details. We hear the word forbearance a lot, and when we start to see the fine print or the actual verbiage from certain lenders, obviously every servicer is a little bit different. We see things that in some cases get to be some pretty scary math. So in some cases you might be skipping 3 payments, but on that 4th payment, you're going to make all 4 at once. So that would be a huge financial burden for a lot of people. So I would say, talk to your servicer, ask them the questions. Is this going to affect my credit if that matters to you? What's the repercussions of me taking this? What's the future plan for it? How long can I have it? Get those answers squared away before you say yes or sign something and go from there.
Yeah.
Because again, you see a lot of different plans that people have, and so we want to make sure that people are in the best financial spot possible. So please ask questions, try to get it documented if possible. Ask lots of questions if you don't understand it, and then just if they have anything, obviously reach out to us. We're here to help them circumnavigate whatever they need to do. But I would say, talk to your servicer and get those questions answered if it's something you can't, if you're not in a spot to make a payment right now.
And we have a quick question from Nicole here.
Not right now.
Give some context to what Stephen was saying here as well, is that there's a lot of people that we consider our direct clients and people that will be our clients for a long time. There's other people that are maybe working with a different real estate agent and just want to maybe reach out for some context or understanding or a different perspective, and know that that's totally fine. Like, as a real estate agent, as a mortgage broker, we're not going to say, oh, here's how you change that. You change agents. So a lot of the stuff it's across the board. It's changing your real estate agent is not going to change it. Changing your mortgage broker a lot of times may or may not actually make a difference. So on that note, Justice Robert says, what's up? Sarah Pape says, hey guys. And Nicole says, with current monthly stats, how much would you say is residual? Because a month ago, our community was under normal function. And what should we expect for the end of April or end of May? Thanks for always leading with transparency and diligence. Grateful for you all. We learned so much. Thank you so much, Nicole. So a couple insights on that, and then Stephen can give any insight that he has, is I would say we have to acknowledge that there is a certain level of long-term impact that all this is taking place on. Like, I think it would be ignorant for us to think May 4th comes around and now it's going to be just like it was this time last year. There's a lot of lenders that are probably for a while, my perspective is probably for a while going to slowly loosen up the regulations. And just like small business, we can look at, the way we did things 3 or 4 months ago, and necessity is the mother of innovation or invention, right? So we're going to do things differently than we did before. I think it's very realistic that with the spike in unemployment that we saw, it's not like the next day unemployment's going to go right back to what it was, because a lot of those employers are no longer around. They could not take this shift in the market. And so some of those employers will be gone. Some of those employers will make decisions that they're going to learn to live off of less. Some of those employers are going to learn that they did not need the third-party systems that they had been relying on. And so I think the unemployment rate, and this goes into economics, that's probably beyond our capacity, because it's a struggle for governors and presidents to figure out. But my expectation is the unemployment's not just going to drop back to what it was. We'll have a significant drop in unemployment, which means we'll have a significant growth in buyers available. And then over time, people will gradually get comfortable, maybe getting closer to that 3 or 4% of whatever's ideal. But a lot of those people are probably going to be on unemployment for a while, and that has an impact on the real estate industry, and that has an impact on the mortgage industry. However, a neutral real estate market is 3 to 6 months of inventory. If we've been around 1 to 1.5 months of inventory for about 4 or 5 years, if tomorrow the amount of buyers is cut in half. If 50% of buyers say, I just can't do this, we're still in a seller's market. If 3 or 4 times the amount of buyers decide that they're no longer looking, inventory begins to fluctuate. Now we're in a neutral market, and most real estate agents or mortgage brokers are not going to complain about even a neutral market, or that would not be as worrisome. So real quick, Stephen, your insight on the long-term impact. What does this mean for a month or two or 3 to 6 months from now?
So actually, it's great timing because I was actually just reading it, and I just pulled it up real quick while we were talking. The MBA just posted their stats for weekly mortgage applications. So it says applications to refinance a home dropped 19% from the previous week, but we're still up 144% from a year ago. And then mortgage applications for purchase fell 12%, but still up 33% year to year. So, I mean, obviously you can see that with this going on, there's going to be a decline in some circumstances because of just the massive amount of unemployment. So I guess all this is going to be how long it actually takes. If we figure this out and, there's a vaccine or there's a fix or everyone gets better in a couple of weeks, that's better than 3 months or 6 months or 12 months from now, right? So it just really depends on that. Obviously, with the amount of unemployment we've seen, we're going to see a decline in the amount of people that want to refinance or can purchase. But those numbers show that obviously we still have some pretty good numbers of people that are trying to refinance, trying to purchase still at this point. So time will tell.
Yeah, and my expectation is that in 2 or 3 months that we'll probably see, at least I'm hoping, a significant increase in inventory, at least for a minute. I think a lot of people over the last 4 or 5 years had kind of accepted this mentality that every month I wait, I get another percent of equity. And so I'll just keep on waiting because history over the last 4 or 5 years is telling me the longer I wait, the more money I get.
Right.
And sometimes it takes a global pandemic for people to realize like the market does ebb and flow, and it does, ebb and flow off of 7 to 10 year cycles. And you can't just expect that 3 months from now, it's going to be exactly like it was 3 months ago. And I think because of that, a lot of people that are sitting on a lot of equity on their home are going to say, hey, you know what? Maybe I don't keep on waiting to cash this out. Maybe I don't keep waiting to move into the next home. Maybe now is a good time to do that. And builders are still struggling to keep up with that inventory as well, filling a huge gap with new construction. But even homes take 3 to 6 months or longer, some 9 to 12 months to build. So I think we'll see a resale increase hopefully a little bit, and then new construction continue to supplement the amount of homes that we have available. So
yeah, we shared that stat a couple times. We actually heard that from Barry Habib, who's the mastermind behind MBS Highway. Very, very smart guy. He was reading that recently. He said that 40% of all homes in America are owned free and clear. Obviously, those people have a ton of equity. And they said of all remaining homes in America that are mortgaged, the median loan to value is less than 60%. So again, even with some swings in there, that people are sitting on a lot of equity, or in some cases, a ton of equity because they own the home free and clear, which means there's no mortgage tax. So there's hopefully some good news coming out of all this.
And I might not have this stat like specifically correct, but it's my understanding as well. Back in 2008, 2009, a lot of people have leveraged the heck out of their homes and have pulled a ton of that equity out, and that is a drastic comparison from people that are comfortable sitting on their equity right now compared to 12 years ago. People were just pulling that equity out for anything, a second home or a car to recalibrate debt or whatever else. So is that correct as well, that people are sitting on more equity and leveraging less of their equity?
Yeah, it was the Wild West back then. I started just after that. So I think I started either late 08 or early 09. It's been so long now. But I definitely have a lot of friends that I work with in the industry that were around during the 04, 05, 06. And it's like your grandparents, man. You sit down with them, you'd be like, tell me about the olden days. And they tell you the stories, and it's like mind-boggling. One day out of bankruptcy with a 505 score, 100% financing. And we would go, they'd do 110% financing on a purchase, just crazy, crazy stuff. So that market and that industry where we came from back in those days, way different now. Obviously now we, ask for blood type, next of kin, like double check everything, dot I's, cross T's, ask for tons of documentation. So hopefully, I mean, beyond obviously huge economic things that were happening right now, these borrowers are very well qualified of what they're in and way, way different from the stuff we were doing back then. And by we, I mean my industry. I wasn't doing it in '04, '05, '06, and '07, but yeah,
Yeah.
it's crazy stories. If you see someone that's in the industry during that time, ask them about what some of the stuff they were doing. It'll blow your mind. It's nuts.
And that's another huge difference between, I think, not I think we know between that market and this market is like, it seems that not a lot of people were paying attention or getting audited or held accountable at that time. And now we have a massive amount of transparency, so much so that when there's a shift in the market, pretty much all the calculations and numbers are laid out in front. And that doesn't mean that there's not credit volatility outside of the mortgage industry or the real estate industry. It means that what's taking place in the real estate industry, we have a lot of confidence, a lot of comfort, a lot of transparency and clarity on what exactly is taking place in that. So what happens outside of that, there's limited capacity on control, but we can, what we can make a difference on, we do. So.
Yep.
I think that's it. Feel free to hit us up with any other questions. Stephen or I or Andre will answer questions that pop up. We appreciate all you all checking in and trusting us to be a valuable, resource for you in real estate and in the mortgage industry. And until next time, see you soon.
See you guys.
All right, bye.
Bye.